You are sitting at your kitchen table, scrolling through the headlines, and you come across Bank of Canada cuts rates. And you think, well, finally, some relief. But then you keep scrolling a little further and read about the US Canada tariff tantrums, companies laying off employees, rising unemployment, fear of inflation making a comeback, and then you're likely left paralyzed about what to do about your upcoming mortgage renewal. So, what should you be doing? Are we actually going to see still lower borrowing cost? Or is this just a short-term sugar rush? And let's also speak about housing. If the rates are dropping, does that mean it's finally cheaper to buy a house in the Greater Toronto area? Or is affordability just a cruel joke? Well, that's exactly what we are breaking down today. Two big questions. Are interest rates going to drop further? And is it actually getting easier? Not necessarily cheaper, but is it getting easier to buy a house in the Greater Toronto area? No jargon, no fluff, just real talk with insights you can actually use. Okay, so Bank of Canada cuts its interest rate by a quarter point, bringing the prime rate down to 4.95%. For variable rate mortgage holders, well, this is a big deal. It translates into real dollar savings. For every $100,000 of mortgage debt, it just got cheaper by $187.50 per month in interest payments. If you got a $500,000 mortgage, that's savings of nearly $1,000 a month. And that's quite a lot of savings. Money not going into your bank's pocket from your pocket. And the same applies for those carrying balances on their lines of credit or the home equity line of credit. And hopefully, none of you listeners are carrying a balance on your credit card month over month. For that's just a very dumb thing to do. Now, the big question is this just the beginning, or will rates drop even further? To understand what's going to come next, let's look at the Canadian economy. It's like checking the health of a patient. If the symptoms are bad enough, more medicine might be on the way. And if Bank of Canada is a doctor, that means more rate cuts. Let's look at the employment or the job seed in Canada. In February 2025, we saw a net gain of only 1,100 jobs, while we added about 43,000 people to our mix. And here's the kicker. Full-time jobs were actually lost, and only part-time work kept the number positive. Unemployment continues to remain high at 6.6%, well, unchanged from January of this year. This figure is in fact even higher in Ontario at 7.6%, a jump of 0.1% from December. So things are not really going in the direction as far as employment is considered. And now add the tariff tantrums that we are seeing right now, and it's only going to get worse likely before it gets any better. And you might ask, Neil, how's inflation? Well, some good news for now. Inflation is at 1.9%, and so it's within Bank of Canada's target of 2%. It's not a big concern right now, and hopefully Canadian government would not increase its retaliatory tariffs to such an extent that it starts to become a problem in future. Right now, Bank of Canada seems to be focused on economic growth and job stability, which are the biggest concerns for the moment. As for GDP, well, Canada's economy grew by 2.6% in Q4 of 2024. Now, that might sound great, well, except most of it was likely on account of temporary spending from the GST holiday, which we had from mid-December to mid-February. and likely preemptive exports to the US ahead of the anticipated Trump's tariff. If this growth doesn't hold up in 2025, then Bank of Canada will likely have to cut rates again later this year. So this is what Bank of Canada said during their announcement about growth, and I quote, Canada's economy grew by 2.6% in Q4 2024, following upwardly revised growth of 2.2% in the third quarter. This growth is stronger than what was expected at the time of the January MPR. Past cuts to interest rates have boosted economic activity, particularly consumption and housing. However, economic growth in the first quarter of 2025 will likely slow as the intensifying trade conflict weighs on sentiment and activity. Recent surveys suggest a sharp drop in consumer confidence and a slowdown in business spending as companies postpone or cancel investments. The negative impact of slowing domestic demand has been partially offset by a surge in exports in advance of the tariffs being imposed. End quote. They also expressed fear about inflation rising and how that could govern their next move. And I quote again, monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. The Governing Council will carefully assess the timing and strength of both downward pressures on inflation from a weaker economy and the upward pressures on inflation from higher costs. The Council will also closely monitor inflation expectations. The bank is committed to maintaining price stability for Canadians. End quote. Now, the retaliatory tariffs announced by Canada, or in fact, in the process of being announced in future, won't help this cause. Americans are punching themselves in their face, and now we are too. It's a very poor choice, but can you think of a better alternative? Now, let's see how our neighbors in the South are faring. The US economy is suddenly looking shaky. And since Canada's economy is tied at the hip with our southern neighbor, we need to pay attention. Their GDP is expected to shrink by 1.5% in Q1 2025. Now, this might turn out to be an anomaly, but hard to say right now. Inflation is again keep creeping up. It touched 3% in Jan, but reduced to about 2.8 in February. This is, of course, making the US Federal Reserve hesitant about cutting rates, even as the full impact of tariffs is yet to be felt. The Federal Reserve is unlikely to cut in March, and their first rate cut is not likely before June of this year. Fortunately for them, unemployment is at the lowest at 4%, but recent federal government layoffs, budgetary cuts, courtesy of Elon Musk, led Doge initiative could make it rise. And this time around, the stock markets are also feeling the pain. Wall Street is down 8 to 12%, NASDAQ being the worst performer among the three major indices in US. Compared to that, the Canadian Stock Exchange is performing better. TSX is down only about 6%, which is still bad, but not as ugly as S&P 500 or NASDAQ. Bitcoin has dropped over 20% from its peak, but is still up 50% in the past year. But the bright spot, I think, is the Canadian dollar. It did fall significantly at the beginning of the year, but has lately held stronger. And a falling US dollar has only helped as we face economic uncertainty. Bank economics are predicting a quarter to three-quarters of a drop in 2025 as far as the prime rate is concerned. This, of course, means that the variable rate mortgages will likely keep dropping unless we get an inflation shock. And Bank of Canada is already expressing its fears about it. Fixed rates, though, are tied to bond yields, which haven't dropped as much. If you are in a variable rate mortgage, I would suggest riding it out a bit longer before locking into a fixed rate. If you're getting a new mortgage or coming up for renewal, I would suggest determining your ability to tolerate risk and the time horizon you have in mind. If you prioritize stability, well, a fixed rate mortgage is still the safer bet, especially at today's rates, which are close to their long term historical averages. Maybe opt for a shorter term. A 3-year rate is pretty good right now. If you're comfortable riding the wave, well, a variable rate could be a good play, but only if banks continue to pass on the full rate cuts to the new borrowers. They are increasingly cutting down on the discounts being offered. Well, if you're on the fence, why choose one boat when you can ride two? A hybrid mortgage, which is a combination of part fixed and part variable, lets you split the risk, giving you the stability of a fixed rate while still benefiting if variable rates drop. It's like having a life jacket while still riding a speedboat. No matter if you're leaning towards a fixed, variable, or hybrid mortgage, make sure to get a quote from me first before negotiating with your bank. Knowledge is your best weapon. Walk into that negotiation ready to win. After all, you wouldn't bring a stick to a gunfight, or would you? For deeper insights, check out my latest blog post. Link in the description. Now that the rates are dropping, you might be wondering, does this mean home prices are finally becoming reasonable? The short answer, unlikely. Interest rates and prices tend to move in opposite directions. Unless we are in some sort of an economic downtrend and there aren't enough buyers looking to purchase. And now happens to be one of those times. Do not forget, this is an anomaly. And when the economy recovers, and it will one day, homes will get more tougher to purchase. I recently published the 12th edition of our Mortgage Intelligence Report, wherein I break down how much income you need to buy in different GTA cities and communities. And here is what the data is telling us. The minimum household income required to buy a home has dropped to 78,000 with 20% down and about 97,500 with 5% down. More first-time home buyers can qualify, but of course in only certain areas. These areas are not in the heart of Toronto, but the outer suburbs, likely an hour or two away. So, where can you find the most affordable places to buy in GTA? Well, if you're looking for single family homes, you are probably looking at the Brock Township in Durham. For semi detached homes, maybe Georgina in New York or Innisfil. For townhomes, Oshawa, Innisfil, or Bradford, West Gwillimbury. For condo apartments, you're looking at likely Humber Heights in Toronto, Orangeville, or Dufferin County. How about areas where it's getting more difficult? Well, these are places where affordability dropped the most or prices went up. On a month-over-month basis, from January to February, the communities which became most unaffordable were Helmo Park or Mount Tennis for detached homes, Thorncliffe for semi-detached homes, Agincourt North, Malvern West for townhouses, Bay Street Corridor, Little Italy, and waterfront communities for condos. And broadly speaking, these are the major trends that we are witnessing right now. Prices of detached homes increased in about 51% of the locations on a month-to-month basis, while only about a quarter of them saw a year-on-year increase. So prices are generally increasing. Affordability has increased in just about 41% of the 73 locations tracked on a month-to-month basis. Biggest drop in affordability was across most communities in the city of Toronto. And this is happening even when mortgage interest rates have been dropping for nearly a year. So, what does it mean for buyers? Well, if you are a first time buyer, you might have a better shot at getting into the market as compared to a couple of years ago. If you are in good financial condition and can expect to be stable with those, then go for a purchase. If you are an investor, there are undervalued areas to watch before prices climb again. It's tough to cash flow properties when rents are also dropping, and so you will need to be choosy. Whoever does the hard work of finding suitable properties will do good in coming years, as home building is right now at a standstill, and prices will eventually increase in a few years. If you're looking to purchase and want to know exactly where you can afford to buy, then download my latest mortgage intelligence report. Link is in the description. So here is the big takeaway. Interest rates are likely to drop further, but don't expect a massive free fall. Buying in GTA is getting slightly easier, but only if you know where to look. If you found this episode helpful, make sure to subscribe, leave a review, and share with a friend who might be looking to purchase or know more. Until next time, stay smart, stay informed, and make your money work for you.